Hello viewers, welcome to my channel. I'm Hashim Ali Khan here. After uploading so many subjects in the playlist, you can find so many subjects, so many videos I have uploaded on different subjects, different topics. I got many requests from my regular viewers to give a video on income tax. So now I have decided to give a series of videos on income tax 2. So in this income tax 2, I'm going to cover up the topics of capital gain, income from other sources, aggregation, clubbing of incomes, and assessment of individuals, assessment procedure. These are the topics I'm going to cover up in this subject called income tax 2. So I'm giving the lectures from the point of view of assessment year 2019-20. 2019-20 will be the assessment year, previous year is 18-19. So from this assessment year previous point of view, I'm going to explain the provisions, I'm going to give the problems on these topics. So keep it in mind, these provisions which I'm explaining now are for the assessment year 2019-20. That's it. So watch the video till the end to get the complete command. See here, income tax is a tough subject compared to other topics of advanced accounting or corporate accounting or business statistics. If you compare with other subjects, this subject income tax is a little bit difficult because so many provisions you have to remember. So you cannot write in your own words, you have to remember the provisions. So until and unless you listen, you watch the theory, you cannot be able to solve the problems. Complete problems depend on the theory which I am going to explain now. So those viewers who are first time joined my channel, I suggest you to visit the playlist of my channel for other subjects. For number of subjects I have uploaded videos on different subjects. Select your subject, select the topic, watch the video, increase your knowledge. Now I am going to start capital gain. Capital gain will arise whenever there is a transfer of capital asset during the previous year relevant to the current assessment year. Our current assessment year time being for our subject, for our lecture is 2019-20. For this assessment year 2019-20, the previous year is 18-19. So if a capital asset is transferred during the previous year, then capital gain, income from capital gain is will be calculated for the assessment year 2019-20. So first of all, I am going to explain you the meaning of capital gain. Any gain arising on the transfer of capital asset during the previous year is chargeable to tax under the head income from capital gain. So according to the provisions of Income Tax Act, 5 heads are there: income from salary, income from house property, profits and gains of business and profession, income from capital gain, income from other sources. So in this, capital gain is the gain arising on transfer of capital asset. The types of capital gain, we broadly divide the capital gain into two types called long-term capital gain LTCG, short-term capital gain STCG. So long-term, the tax liability will be different for long-term capital gain and short-term capital gain. Long-term capital gain is taxed at a flat rate of 20% for the current assessment year. Current assessment year immediately means 2019-20. So for the current assessment year, the LTCG is taxable at a flat rate of 20% plus surcharge plus health and education cess of 4%. Whereas short-term capital gain will be included with other incomes like income from salary, income from house property, income from business, income from other sources. Along with other incomes, short-term capital gain will be included and taxed at slab systems. Whereas in special cases, it is calculated at a flat rate of 10 or 15%. But normally it will be included along with other incomes and taxed at slab system. That is short term. Later on we will discuss about what is short-term capital gain, what is long-term capital. Right now you remember the tax liability on LTCG and STCG. Essential conditions to be satisfied by the SSC to charge an income as capital gain. An SSC has to decide that what are the conditions to be satisfied so that his income is chargeable under that income from capital gain. So Income Tax Act has given elaborate provisions. What is capital asset, when the gain arising from capital asset is chargeable to tax under income from capital gain. The first condition, SSC holding an asset. The SSC must to hold the asset whether he has purchased it or he got it in special mode of transfer, like he got it through gift or by a will or by inheritance. In different circumstances, special cases, he got the ownership. Or normal circumstances, a person will get the ownership by purchasing the asset. So first of all, the SSC must be the owner of the asset. He must hold the asset. Secondly, transferring of asset. During the relevant previous year, relevant to the current assessment year, during the relevant previous year, relating to the current assessment year, the SSC must transfer the asset. For example, current assessment year 2019-20, previous year 18-19. During the year 2018-19, the SSC must transfer the asset. Must transfer the asset. Then only the gain arising is taxable under income from capital gain. Third one is must be profit or loss. On transfer of the capital asset, there should be a profit or a loss arising. Then only it will be taxable. If there is no profit, no loss, no question of including it in income from capital gain. Not exempted under section 54. Later on in this theory, I am going to explain you the exemptions to be given under section 54 from income from capital gain. So these are the conditions to be satisfied by the SSC so that his income is chargeable under that income from capital gain. Now, meaning of capital asset and its classification. First and foremost thing is, we have to decide what is a capital asset, what is the classification of capital asset. Without that, we cannot be able to decide how much is the LTCG or STCG, how much is tax liability on capital gain. All these things will decide on the theory of capital asset. Capital asset means any asset which is held by the SSC not for sale. It may be tangible, it may be intangible, it may be fixed, it may be circulating. Any asset not held for the purpose of sale. It is not stock in trade. It is an asset which is held by the SSC for use or for personal or business purpose. That is called capital asset. Now we classify capital asset into three categories. That is tangible non-financial assets, tangible financial assets, intangible assets. Tangible non-financial assets. Tangible non-financial assets are like land, building, machinery, gold, ornaments, etc., which are physical existence. The assets which are physical existence are called tangible non-financial assets. Tangible non-financial assets. This point you have to remember because the provisions will be different for different types of assets. Then tangible financial assets. The tangible financial assets are shares, bonds, debentures, securities, etc., which does not have physical existence, but which is evidenced by a contract. Then intangible assets. Intangible assets like goodwill, patent right, then copyright, then this brand name, etc. These are called intangible assets. And capital asset does not include the personal assets which are used in our day-to-day life, just like television, refrigerator, or household furniture, or a car, or scooter. These are the personal assets which are not capital. Any gain arising on the sale of this personal asset are not chargeable to tax. Similarly, some assets are there which are of archaeological importance, like drawings, paintings, or other sculptures, etc. These are capital asset, and gain arising will be taxable under the capital gains. And agricultural land situated in rural area is not a capital asset, whereas agricultural land situated in urban area is a capital asset. So these provisions you have to remember. Now I am explaining you about the nature of capital asset, short-term capital asset and long-term capital asset. See here, the tax liability depends on the nature of capital asset, whether it is a long-term or short-term. So concentrate now. So what is long-term and capital? The nature of capital gain is the basis for determining the capital gain. Generally, long-term capital gain is taxed at a flat rate of 20%. Whereas short-term capital gain is taxed at slab system along with other incomes, but in some special cases it will be taxed at a flat rate of 10 to 15%. Now, for what is the tax liability for how to decide whether it is a long-term capital asset or short-term capital asset? Here concentrate now. First of all, we'll discuss about tangible non-financial assets. Tangible non-financial assets. In this tangible non-financial assets, first of all, we'll take the case of land and building. Land and building. If the period of holding of land and building is 2 years or less than 2 years, it is called short-term capital asset. For example, if a person has purchased land and building and sold land and building within a period of 2 years, within a period of 2 years of purchase, but that means the period of holding from the date of purchase to the date of transfer, that period is less than or equal to 2 years, then it will be called as short-term capital asset. Any gain arising will be short-term capital gain. If the land and building is held for more than 2 years, the time gap between purchasing the land and building and sale of land and building is more than 2 years, it will be treated as long-term capital asset. The gain arising will be long-term capital gain. So 2 years, you have to remember, 2 years or less short-term, more than 2 years long-term. Which type of asset? Tangible non-financial asset, land and building. Land and building. Apart from land and building, other non-financial assets, non-financial tangible assets, the period of holding is 3 years. The period of holding is 3 years. If an asset is held for 3 years or less, it will be called short-term capital asset. If the period of holding is more than 3 years, it will be treated as long-term capital asset. For which type of assets? Non-financial assets. Tangible non-financial assets other than land and building. So we have categorized into two: land and building, other than land and building. Land and building, 2 years. Other than land and building, 3 years. That is a deciding factor to decide short-term and long-term capital asset. Then financial assets. Now I am discussing the provisions regarding tangible financial assets. Here some complications are there. The tangible financial assets are divided into 3 categories. First category, securities listed in recognized stock exchange. Those shares or securities which are listed in recognized stock exchange, or units of equity oriented units of UTI, or zero coupon bonds. Remember, the securities which are listed in a recognized stock exchange or units of equity oriented of UTI or zero coupon bonds. For these 3 types of securities, financial assets, the period of holding is 1 year. The period of holding is 1 year. If an asset is held for 1 year or less than 1 year, it will be short-term capital asset. If the asset is held for more than 1 year, it will be long-term capital asset. So you have to remember this. To decide short-term or long-term, 1 year period for those securities which are listed in the stock exchange or units of UTI or zero coupon bond, 1 year period. For next one, unlisted shares. If the shares are not listed in the stock exchange or dealt with privately, then 2 years is the period. If the securities are held, unlisted securities are held for 2 years or less, it will be short-term capital asset. If it is held for more than 2 years, long-term capital asset. For which type of security? Unlisted security. Third one, units of debt-oriented funds. There are 2 types of fund: equity-oriented, debt-oriented. Equity-oriented means 1 year. If it is debt-oriented fund, it will be 3 years. Then your unlisted security other than shares. If there are security unlisted other than shares or other non-financial assets, for these assets, 3 years is the period. So remember now, again I am repeating, for financial assets you have to see if the securities are listed in a recognized stock exchange, 1 year. For equity-oriented units of UTI, again 1 year. For zero coupon bond, 1 year. For unlisted securities, 2 years. For other securities, 3 years. These are the provisions to decide whether it is a short-term or long-term capital asset. Because ultimately I told you the taxability of capital gain depends whether it is a long-term capital gain or short-term gain. How to decide whether it is a long-term capital gain or short-term capital gain? We have to see whether it is a long-term capital asset or short-term capital asset. So I have explained you regarding land and building and other non-financial assets. Then financial assets I have explained you. But some points, special points you have to remember. The special points are, first one, if the listed security, if the listed shares or equity oriented units, if the listed security, listed means the shares which are listed in a recognized stock exchange or equity oriented fund units are transferred through exchange, then in that case security transaction tax, it is called STT. यानी अगर कोई आदमी रिकॉग्नाइज्ड स्टॉक एक्सचेंज में शेयर्स बेच रहा है तो उसके ऊपर एसटीटी अप्लाई होगा, सिक्योरिटी ट्रांजैक्शन टैक्स, एसटीटी. इन दैट केस long term capital gain on such security is exemption is up to 1 lakh rupees. Excess of 1 lakh rupees is taxable at 10% without allowing the benefit of tax indexation. Now up to 1 lakh rupees capital gain is exempted if they are the shares which are listed in the stock exchange or units of equity oriented units of UTI. So if these shares are transferred in a recognized stock exchange on which STT is payable, in that case up to 1 lakh rupees exempted. Over 1 lakh rupees, if capital gain is there, it will be taxed at 10% flat without indexation. Secondly, if the listed shares or equity share oriented are transferred privately, if the listed shares are not exchanged through stock exchange, privately it is exchanged, or unlisted shares are privately exchanged, then in that case STT is not payable. STT, security transaction tax, will be payable only if it is exchanged through stock exchange. If it is not transferred through stock exchange, STT is not payable. When STT is not payable, the SSC is given an option that long-term capital gain is taxed at 20% flat, 20% flat with indexation, or 10% flat without indexation. Simple means, if a person is having a security which is transferred not in a stock exchange but privately, or unlisted security not listed in any stock exchange, he has transferred it privately, not paying STT. STT not paid. In that case, income tax will be LTCG, long-term capital gain tax, will be 20% with indexation or 10% without indexation, whichever is beneficial to the SSC. That is the provision. So I have explained you the nature of capital asset. Now I am going to explain you about the advance money received and forfeited. Sometimes it may happen an SSC has transferred the asset through a sale deed. In that sale deed, some advance money is received from the buyer. So the transferor has received some advance money from the buyer and he has given some period of time. But later on, the buyer has refused to purchase, declined to purchase, negatived the sale deed. In that case, the advance money will be forfeited by the transferor. The SSC will forfeit. For example, Mr. X is the SSC. He has agreed into a sale deed with Mr. Y, saying that within 3 months you have to make the payment and take your asset. And for that purpose, some advance money, suppose if 50,000 rupees advance money, token money has been given. And condition that if you do not materialize the transaction up to so and so date, the advance money will be forfeited. Now he has not materialized, advance money forfeited. Now how to treat this advance money forfeited? So if the advance money is forfeited after 1/4/2001, remember the date, 2014, sorry, 1/4/2014, 1st April 2014. After 1/4/2014, if advance money is forfeited, then this advance money forfeited will be taxable under income from other sources. Income from other sources. If the advance money is forfeited before 1/4/2014, it will be deducted from the cost of acquisition. Deducted from the cost of acquisition. These are the provisions regarding advance money. Now transfer of capital asset. See here, one of the conditions for charging income from capital gain, putting the tax on income from capital gain is the asset must be transferred. So when we can say the asset is transferred, different cases are given by the provisions of law. The first case is sale. The normal circumstance in which the asset will be transferred between two parties, two persons, is through sale. In the sale transaction, the seller will part away the goods, part away the asset, and the buyer will take the asset for a price, for a consideration. That is the common mode of transfer of asset. The very commonly mode adopted is sale. Second is exchange, barter system, where goods are transferred without the use of money. Without the use of money, the goods are transferred. For example, Mr. X is having a building. He sold the building to a company, and from the company he has not received cash. He has received the shares. That means there is an exchange. The SSC has transferred the building, and in return he got the shares. It is called exchange. That also amounts to transfer. And Income Tax Act will calculate what is the value of the transfer, and accordingly tax has to be paid. Similarly, relinquishment. Relinquishment means voluntarily transferring the ownership to other person. Voluntarily. Example, Mr. X is the SSC. Voluntarily he has transferred his own building to the partnership firm. He has transferred his own building to the partnership firm. It is called relinquishment. The next one is extinguishment. By operation of law, the ownership will be compulsorily transferred by operation of law. Example, in case of fire, insurance company will take the property after paying the insurance claim. After paying the insurance claim, the insurance company will take charge of the assets. Then compulsory acquisition. In some cases, the government will compulsorily acquire the property. Example, in case of railway tracks. For putting the railway tracks, the government has acquired the land of the SSC. It is called compulsory acquisition. That also amounts to transfer. Next, conversion of capital asset into stock in trade. Sometimes an SSC has purchased a capital asset. Later on, he has converted that into stock in trade. Example, Mr. X has purchased gold, not for the purpose of sale, but for use. So it's a capital asset. He has kept the gold with himself for 5 years period. After 5 years period, he has started the business of gold. He has started a shop, gold shop. In that case, he has converted his capital asset, 5 lakh rupees worth of gold he has purchased 5 years back. Now he is converting that 5 lakh rupees worth of gold into his stock in the shop. That is called conversion of capital asset into stock in trade. So Income Tax Act says this conversion of capital asset into stock in trade is also a transfer. And any gain arising on this conversion will be treated as a capital gain. It will be taxed. That's all. So these are the cases where there is a transfer of asset. Now capital gain. Capital gain is the difference between the consideration received and the cost of acquisition. Capital gain will arise whenever the consideration is more than the cost of acquisition. Example, Mr. X has purchased the gold for rupees 8 lakh. He has purchased the gold for 8 lakh. And after a period of time, he sold the gold for 12 lakh. So purchased the gold 8 lakh and sold the gold for 12 lakh. So 12 lakh rupees is the consideration received, and 8 lakh rupees is the cost of acquisition. So 12 lakh minus 8 lakh, 4 lakh rupees is called capital gain. So if consideration received is more, there is a capital gain. If cost of acquisition is more, there is a capital loss. So simply we can say capital gain is equal to consideration received minus cost of acquisition. Positive figure capital gain, negative figure capital loss. Next one is cost of acquisition. The cost of acquisition is the price paid at the time of acquisition of the asset and all incidental expenses incurred to purchase the asset. Example, if Mr. X has purchased a house for rupees 50 lakhs. By paying 50 lakh rupees, he has purchased the house. That is the cost of acquisition. Apart from purchasing the house, he has paid the brokerage charges, registration charges. All these are the incidental expenses incurred to purchase the asset that will be added. So capital gain. Capital gain is the difference between consideration received and the cost of acquisition. If the consideration received is more than the cost of acquisition, there is capital gain. If cost of acquisition is more than consideration received, there is a capital loss. So simply remember the formula: capital gain is equal to consideration received minus cost of acquisition. If you get positive value, it's capital gain. If you get negative value, it is capital loss. Next is cost of acquisition. The cost of acquisition is the cost of purchase. What is the purchase price of asset to the SSC? This cost of acquisition includes all incidental expenses also. Example, Mr. X has purchased a building for rupees 50 lakh. To purchase that building, he has paid some brokerage, commission charges and also registration charges. All these are incidental to the purchase. So it will be added in cost of acquisition. Then rule: if an asset is acquired before 1/4/2001. The Income Tax Act has given a provision that if an asset has been purchased before 1/4/2001, the SSC can choose the fair market value as on 1/4/2001 as the cost of acquisition. As the cost of acquisition, the SSC can choose the fair market value as on 1/4/2001. But this benefit will not apply to depreciable asset like machinery. If machinery is used in the business, it is called a depreciable asset. So for depreciable asset, this FMV provision will not apply. Now next one is indexed cost of acquisition. Indexed cost of acquisition means increased cost of acquisition or inflated cost of acquisition. Normally what will happen, on account of inflation, the value of money will not remain same. The value of money will change. If we treat the value of money as same, it will be a big burden on the SSC to pay more tax liability, because at the time of purchasing the asset, the value of money was more. At the time of sale of the asset, the value of the money has been come down on account of inflation. The value of money is different at two different point of time, at the time of purchase and at the time of sale. To combat that, Income Tax Act has given one provision called indexing the cost of acquisition, inflating the cost of acquisition. What will happen if indexing cost is made? The tax liability will get reduced because we are increasing the cost of acquisition. When cost of acquisition is increased, the capital gain will decrease. When capital gain decreases, the tax liability will also decrease. That is the benefit of cost of acquisition. So specific provisions are given. So how to find out the cost inflation index? The government will notify the cost inflation index time to time. What is the inflation rate according to the inflation rate? So here the index number has been given from 2001-2002. The first index number 100 is for the year 2001-2002. So if an asset is purchased before 2001-2002, then also we can take the index number as 100. So any asset which is purchased on or before 2001-2002, the index number can be taken as 100. And after 2001-2002, every year the index numbers are notified by the government. So you have to remember the first 2001-2002 as 100. Remaining all index number, there is no need to remember. It will be given in the problem. Current previous year index number you have to remember. Our current previous year is 2018-2019. So 2018-2019 the index number is 280. You have to remember this. The current previous year index is 280 and the index number of 2001-2002 is 100. These two index number you remember. Remaining all index number will be specified in the problem. So by using these index numbers, we will calculate the indexed cost of acquisition. The formula for indexed cost of acquisition is actual cost of acquisition into index number of the current previous year. Index number of the current previous year is 280. Index number of the current previous year 280. The actual cost of acquisition into 280 divided by index number of the year of purchase. Index number of the year of acquisition. So in which year the asset was acquired, that index number. For example, the asset was acquired in 2006-2007. Example, the asset was acquired in 2006-2007. At that time, what is the index number? 122. So how to find out indexed cost of acquisition? Actual cost into 280 divided by 122. Into 280 divided by 122. You will get indexed cost of acquisition. So how to calculate capital gain? Take the consideration received minus indexed cost of acquisition. Now, when to index and how to index, some provisions are given. Now I am explaining you the provision. This benefit of indexed cost of acquisition will be given only for LTCG. For short-term capital gain calculations, indexing should never be done. Indexing is allowed only for LTCG, long-term capital gain. Similarly, the above said rule does not apply to shares or debentures acquired by non-resident Indians. Non-resident Indians in foreign companies. उसी तरह depreciable assets. Indexing will never be applied to depreciable assets. And indexing will never be applied to short-term capital assets. That's all. So these are the provisions you have to remember regarding indexed cost of acquisition. Now, cost of improvement. Sometimes some additions are made to the capital asset. That is called improvement. For example, Mr. X has purchased a building. Actual cost of the building was 60 lakh. The actual cost of acquisition is 60 lakh. After purchasing the building, after 1 or 2 years, he has added one more floor or 2 more floors on the building. This is called improvement. That means the capacity of the asset has increased. The value of the asset has increased. He has actually purchased for 60 lakh. After 2 years, he has constructed one more floor by incurring an expenditure of 10 lakh. So this 10 lakh rupees he has incurred is called cost of improvement. So indexing will be done for the acquisition as well as for the improvement. So indexed cost of acquisition and indexed cost of improvement, both will be deducted from consideration received. Right? Assets acquired under special mode of transfer. See here, one of the first condition we have studied is the income from capital gain is chargeable to tax only if the SSC owned the asset. So how the SSC can be able to acquire the ownership of the asset? Two ways. One, normal case and the special case. In normal case, the SSC will purchase the asset, will acquire the asset by paying the price. The purchase price. By paying the purchase price, he got the acquisition. He got the ownership. This is the normal mode of getting the ownership. Second, special cases are those cases in which the SSC has not paid anything for acquiring the ownership. Like example, in case of gift. If somebody has gifted the property, he got the ownership but without paying anything. This is a special mode. Similarly, through a will. Suppose a person through a will has transferred the property to the SSC. So he got the property through a will. Similarly, some SSC will get the property by inheritance from the parents. That is also a special case. So in all these cases, the cost of acquisition of the present SSC is the cost to the previous owner. Is the cost to the previous owner. This is called assets acquired under special mode of transfer. Distribution assets to members of HUF on partition. Hindu undivided family is there. Or at the time of partition of HUF business, the assets will be distributed among the members, co-partners. So co-partners, without paying anything, they are getting the property assets from the HUF. This is a special mode of getting the ownership. Similarly, gifted property. When property is gifted, not paying anything, got the ownership. Similarly, property is acquired out of will. By writing a will, a person can transfer the property to another person without paying anything. Inherited properties. Normally, this case will happen that the property of the father will go to the son, inheritance. Without paying anything, the son got the property through inheritance. Similarly, distribution of assets on dissolution of firm. Suppose a partnership firm is dissolved. The assets of the firm are distributed among the partners. The partners are getting freely from the firm. Similarly, distribution of assets on the dissolution of the company. Sometimes company got liquidated. Very rarely this will happen. A company got liquidated, assets are distributed among shareholders. So this is the rarest of the rare case. So these are the special cases where the SSC got the ownership of the property and he is liable to pay tax on capital gain if he transfer the asset. Now, components for calculating capital gain. For calculating capital gain, we need 4 items. The first is consideration receipt. Consideration is the amount which is received by the transferor or the SSC on transferring the property. This is the amount which is received by the transferor or SSC in transferring the property. Then second one, transfer expenses. Normally what will happen, in order to transfer the asset, some expenditure is incurred like commission, brokerage, or other transfer fees are there, registration fees is there, stamp duty, all these things are there. These are the transfer expenses. It will be deducted from consideration received. So first we need consideration received minus transfer expenses, will get net consideration. From net consideration, we deduct cost of acquisition and cost of improvement, or indexed cost of acquisition and indexed cost of improvement, to get income from capital gain. So this is the procedure of calculating income from capital gain. Now you can see the procedure of computing the income from capital gain. The format of computing the income from capital gain is like this. Computation of income from capital gain of what is the name of the SSC will write on. Then for the assessment year, write the assessment year. Remember, I am explaining the provisions for the current assessment year, which is 2019-20. This is the assessment year. For this year, the previous year is 18-19. 2018-2019 is the previous year. Now, the computation consists of 2 columns at the extreme right hand side. Consideration received. First we should take. From consideration received, we deduct transfer expenses or selling expenses like commission, brokerage, etc. Deduct it, we'll get the net consideration. From this net consideration, we deduct 2 items. That is indexed cost of acquisition and indexed cost of improvement. Already I explained earlier the indexed cost of acquisition, how to calculate. Take the actual cost of acquisition into index number of current previous year. The current previous year index number is 280 divided by index number of the year of purchase. Like this we can calculate indexed cost of acquisition and indexed cost of improvement. So add up both indexed cost of acquisition, indexed cost of improvement if it is any. Then take the total in the outer column, subtract. Net consideration minus this indexed cost. Then we'll get capital gain. From capital gain, if there are any exemptions available under section 54. Now I am going to explain you what are the exemptions, when it will be allowed. Everybody will not get, only on satisfying some conditions. Exemptions under section 54 will be allowed if it is there. Then this itself, then if there are no exemptions available, then this in capital gain itself will become the income from capital gain. So deduct the exemptions under section 54, we get income from capital gain, LTCG, long-term capital gain. This is the format of computing the income from capital gain. Now I am going to explain you the exemptions and some more items regarding transfer of depreciable assets. See here, sometimes a depreciable asset will be used in the business by the SSC. Though any gain arising on the depreciable asset will always be treated as short-term capital gain, irrespective of the period of holding. Even if the SSC hold the asset for more than 10 years, 15 years, still the gain arising on the sale will be treated as a short-term capital gain. Indexing will not be allowed. So what are the depreciable assets? According to Income Tax Act, depreciation is allowed on building, machinery, plant, furniture. So building, machinery, plant, furniture, these are the only assets on which depreciation will be allowed. So if during the previous year, if any of these assets are sold, transferred, then gain arising will always be treated as a short-term capital gain. No indexing will be allowed. This is the provision you have to remember. Now, exemption from long-term capital gain under section 54, 54B, 54D, etc. Many more exemptions are given under section 54. So why this 54 section exemptions are given? Here some explanation I will, then I'll discuss about the exemptions. So in order to promote investment, the government priority is the people should make the investment in priority sector or in specified areas, and to provide financial security Income Tax Act provides a relief to the SSC on transferring some assets, certain assets, long-term capital assets. That means in order to promote investments, what will happen if the people start investing the income, then definitely there will be growth in capital formation of the country. The government encourages the people not to spend the money but to invest it. If you make the investment in priority sector, government, the law says we will give the exemption to you under section 54. If exemption is availed, then what will be the result? The tax liability of the SSC will come down. So the government intention is to encourage the people, the taxpayer. If you want to reduce the tax liability, you invest your income in so and so priority sector. Then we will give the exemption under section 54. What is the effect of this exemption? Here the provisions are given. Purchase or construction or investment within the stipulated period. So if a person is having income from capital gain, then he has to purchase, construct or invest his income, capital gain, within a stipulated period. Not always, only for a stipulated period. Suppose Mr. X has sold a building, then he got the consideration. From that consideration, if he make the investment or purchase or construct within the stipulated period, the law says we will give you exemption. Secondly, SSC must retain the ownership of new asset for a minimum period of 3 years. Once he has made the investment or purchased the asset, he should not sell it immediately. At least 3 years he has to hold the new asset. Hold the new asset. Then third one is, if the amount is not utilized for purchase or construction or investment, the amount can be deposited in a branch of public sector bank in accordance with capital gain account scheme. Sometimes what will happen, the SSC has sold an asset, transferred an asset, he got the capital gain. Now immediately he cannot be able to make the investment or purchase another property or goods like that. So Income Tax Act says, till the time, if you cannot be able to purchase it, deposit that consideration received or capital gain in a public sector bank in accordance with capital gain account scheme. So he has to go to a public sector bank and should say that I want to deposit so and so amount in capital gain account scheme. So a special type of account will be opened for that person in the bank, public sector bank, and the amount will be deposited in capital gain account scheme. He will get the exemption. So to get the exemption, he has two options. First option, he has to purchase, construct or invest the new investment, new asset within the stipulated period. He should not sell away the new asset within a period of 3 years. Thirdly, if he is unable to purchase the new asset, he can be able to deposit that amount in a public sector bank in a capital gain account scheme. These are the provisions of exemptions. Now we'll discuss one by one exemption. The first exemption is under section 54. Now concentrate here now, because these provisions we have to apply in the coming problems. Section 54. Exemption from long-term capital gain from residential property. Remember the word residential property. If an SSC has sold a residential property and purchased a new residential property within the stipulated period, he will get exemption under section 54. So 2 points you have to remember. Selling the residential property and purchasing the residential property within the stipulated period. So what are the provisions here? The SSC has transferred or sold a residential house. Whether the house is let out or self-occupied doesn't matter. The provision will apply on both the houses, self-occupied or let out. So if the SSC has transferred a residential house, let out or self-occupied, and purchased or constructed one house only for residential purpose in India, after selling that house, he has to purchase or construct one residential house in India. Then only exemption will be given. So what is the gist of this provision? He should sell one residential house and purchase another residential house in India. Then exemption, list of the following two will be exempted. First one, cost of the new asset plus amount deposited in capital gain account scheme. If he is unable to purchase the new asset, he can deposit the money in the capital gain account scheme. So first, the cost of the new asset plus amount deposited in the capital gains account scheme, or second, capital gain amount. Whichever is less. In these two amounts, whichever is less will be given as exemption under section 54. Now, time limit. What is the time limit? The purchase of the house within 1 year before or 2 years after the date of transfer. From the date of transfer, 1 year before or 2 years after, he should purchase a new house. The time limit given 1 year before or 2 years after the date of transfer. Secondly, construct the house within 3 years. If the SSC is not purchasing, he is making the construction, constructing the house. So within 3 years from the date of transfer, this is the time limit to avail the exemption under section 54. So we have completed one exemption, that is section 54. Now the next exemption under section 54 is 54B. So we have already discussed the exemption under section 54, that is selling one residential house and purchasing another residential house within the stipulated period. Exemption will be given under section 54. Now 54B, what are the provisions when the 54B exemption will be given? Now I am explaining. Capital gain on agricultural land. See, what is the provision regarding agricultural land? The capital gain on transfer of rural agricultural land is not taxable. Is not taxable. If the agricultural land is located in rural area, then gain arising is not taxable. But agricultural land in urban area, the capital gain is fully taxable. So exemption will be given when transferred, urban agricultural land is transferred. So under section 54B, capital gain arising from the transfer of agricultural land, exemption can be given as agricultural land used at least for 2 years. Before transferring, at least 2 years, the land must be used for agriculture purpose. And secondly, investment in purchasing agricultural land either in rural or urban area. See here, when we transfer, the transferred asset should be urban agricultural land. But when you purchase new agricultural land, the new agricultural land may be rural or may be urban. That means selling one agricultural land and purchasing another agricultural land. Selling urban area agricultural land and purchasing any land, urban or rural. Then exemption list of the following two: cost of the new agricultural land plus amount deposited in capital gain account scheme. What is the cost of the new agricultural land? For example, one agricultural land was sold for rupees 60 lakh and we got a capital gain. Now we have to find out how much is the cost of the new agricultural land and how much amount deposited in capital gain account scheme. Add up both, or capital gain amount, whichever is less. First we have to calculate capital gain. How to calculate capital gain? Take the consideration received minus selling expenses, net consideration, from that deduct indexed cost of acquisition, will get the capital gain. After calculating capital gain, we have to deduct the exemption under section 54B. So for giving the deduction, we have to make the calculations. We have to see what is the cost of the new land and what is the amount deposited in capital gain account scheme, or what is the capital gain amount. Already we got it. Whichever is least in these two is the exemption given under section 54B. And the time limit is the purchase of the new agricultural land within 2 years from the date of purchase. That means the new agricultural land should be purchased within 2 years from the date of transfer. From the date of transfer. From the date of transfer. That's all. These are the provisions regarding 54B. Now I am coming to the next exemption, 54D. On what conditions this 54 exemption D will be given? Now see, capital gain on compulsory acquisition of land and building which are used for industrial undertaking. Example, if an SSC is having an industrial undertaking using for industrial purpose, and that industrial land and building is compulsorily acquired by the government and compensation given to the SSC. So if such is the case, then exemption will be given under section 54D. Now see here, compulsory acquisition of land and building by government used for industrial purpose for 2 years before transfer. Suppose Mr. X is using this land and building for industrial purpose for at least 2 years. And after 2 years, the government has notified that this land and building will be compulsorily acquired by the government. In that case, the compensation received is the consideration. Now, must purchase another land and building for industrial purpose. Must purchase another land and building. Must purchase another land and building for industrial purpose. Then this exemption under section 54D will be allowed. The exemption list of the following two: cost of the new asset, new land and building, plus amount deposited in capital gain account scheme, or capital gain amount, whichever is less. So first we have to compute how much is the capital gain amount. Then in working note we have to find out how much is the cost of the new asset plus amount deposited in capital gain account scheme, or capital gain amount, whichever is less, is the exemption under section 54D. Time limit within 3 years after receiving the compensation. That means the new land and building must be purchased within 3 years from the date of getting the compensation. Now section 54F, exemption under section 54F, long-term capital gain from other assets other than residential house and purchasing or constructing a residential house. That means long-term capital gain arising from the transfer of any other asset other than residential house. Other than residential house, any other capital asset is sold and long-term capital gain is arised, and from that he is purchasing or constructing a new residential house. The transferred asset may be any asset other than residential house. The asset which is sold should be any asset other than residential house. Secondly, investment in one residential house. तो कोई भी दूसरा एसेट बेचेंगे और वो पैसे से एक नया रेसिडेंशियल हाउस परचेस करेंगे. Then this exemption will be allowed. Exemption list of the following two: if the cost of the new house is more than the consideration received, then entire capital gain amount is fully exempted. Now we have to compare what is the cost of the new house and what is the consideration received. If the cost of the new house is more than the consideration received, then full amount of capital gain will be exempted. Or if the cost of the new house is less than the consideration received, exemption will be given proportionately. If the cost of the new house is less than the consideration received, then proportionately capital gain will be exempted. How much proportion? Exempted capital gain is equal to actual capital gain into cost of the new house divided by consideration, net consideration received. So this formula will be applied if the cost of the new house is less than the consideration. If the cost of the new house is more than the consideration received, entire capital gain will be exempted. Now time limit: purchase of house 1 year before or 2 years after the date of purchase, or construct the house within 3 years from the date of transfer. Constructing the house within 3 years from the date of transfer. So this is the provision regarding 54F. Now the next exemption is under section 54EC. Only important exemptions I am explaining. Some more exemptions are there, but they are very rarely used exemption, but these are the commonly we'll find in the problems. So 54EC, long-term capital gain on transfer of any asset and investment in specified bonds. So Income Tax Act says if any asset is sold and from the consideration received purchasing or investing in specified bonds. The Income Tax Act has given a specific list of specified bonds. So if investment are made in those specified bonds, exemption will be allowed under section 54EC. If long-term capital asset is transferred during the previous year and if gain is there, the SSC can claim this exemption if investment is made in specified bonds. So during the previous year, any capital asset is sold, gain arised, long-term capital gain, and that will be used for purchasing specified bonds. Then exemption can be given. Transferred asset, any land or building or both long-term. Then investment in specified assets. Examples of specified assets, few examples I have given here: bonds of Rural Electrification Corporation, National Highway Authority of India, Power Finance Corporation Limited or Indian Railway Finance Corporation Limited. These are the few specified bonds, specified areas where the SSC can invest the funds and get the exemption. So time limit within 6 months from the date of transfer. When it transfers the asset, within 6 months he has to make the investment in bonds. So exemption list of the following to actual amount invested or rupees 50 lakhs. This is the provision regarding section 54 EC. So in this video I have explained you the main theory. Remember, it's not the complete theory. Only from BCom point of view, what is important I have explained, not in depth. Only the thing which, only the problems, the knowledge which is required for a graduate student for BCom, I have given this theory. And if you watch the theory completely from beginning till end, definitely you can able to solve the problems on capital gain. So I'll end the theoretical part here. Next video I'll start the problems on capital gain. So before starting the problem, I expect that my viewers have completely watched this theory. Without understanding, without watching this theory, you cannot be able to understand the problems. So I'll continue in the next video, the next problems on capital gain. So if you are satisfied with my lecture, give a like to the video. Subscribe my channel if you have not yet subscribed. Share it in your group, in your friend circle, so that more and more students can watch these videos, can acquire more and more knowledge. And give your comment, give your messages in the comment. We'll continue this in the next video, the problems on capital gain.